Advisors. We'll probably speak for about 45 minutes and then have a Q&A session at the end. So please, at the bottom of your screens, feel free to submit questions via the Q&A tool, and we'll try and get to all of them at the end. Before I do kick things off, I'm going to give a quick overview of Exit Advisors and introduce our panel speakers for today. Exit Advisors is a lower middle market M&A advisory firm, and we work with entrepreneurs and seasoned business owners to develop an exit strategy that fits their needs and the needs of the business. And we accomplish that by really working with you intimately, most cases months in advance, so that we can help assist in de-risking the business, improving operations, and ultimately adding value. That's always the end game. Our team has an immeasurable knowledge, not only from transaction and finance experience and experience working directly with businesses, but also because our leadership team are entrepreneurs themselves. Gary and Alice especially built successful businesses and have gone through this process themselves, which is really important because I like to say this, they live and breathe the transaction from both sides of the table. And we also partner with the best advisors that have the knowledge and the tools and the resources to help execute a successful deal. So on our panel today, we have a few familiar faces. Gary Cooper, obviously the managing partner of Exit Advisors and CEO of Cooper CPA Group. Aaron Ball, who we've had before, corporate attorney from Ball Wheelberg Attorneys. And then, of course, our newest member, Mark Zajac, the new president of Cooper CPA Group and former audit partner with KPMG. So got a great bench today. And, today's focus is going to be on deal structure and the things to consider before going to market, or even while working with certain types of buyers when we are going to market. And that's going to lead us into our first topic for discussion today, which is buyers. And Gary, I'd like you to kind of start us off, but we have two main types of buyers, strategic and financial. And I'd like you to maybe kind of go through them for a minute and explain what their differences are, maybe some benefits that each can provide, and then maybe Aaron and Mark can chime in.
Well, a strategic purchaser is someone who's potentially a competitor or someone who's in the same line of business that you're in. This is always a great advantage to get a strategic purchaser. One of the main reasons is what you call normalization adjustments or add backs. And so if your strategic purchaser is already covering certain expenses associated with your business, those particular expenses can be added back. So once you add expenses back to what they call the benefit stream, then you apply the multiple, 3 times, 4 times, sometimes referred to as the capitalization rate, discount rate, inverted. And so obviously, if you have an investment banker that you've hired, it's going to be more advantageous to try to find that strategic purchaser. You're going to probably get a much better value, and you're probably also going to have a better integration process with your business line. We've even had some instances where it's based on the gross profit margin versus net income, because everything is pretty well absorbed down into fixed and semi-variable cost. Then, of course, you get into the financial buyer, private equity individual. This is somebody who's typically not in your line of business. So the add backs are fewer and far between. And so basically what that does is it shrinks down your benefit stream to apply the multiple to. And in some cases, even with a strategic transaction, you can get a higher multiple. Right now, for instance, dentistry, there's a lot of opportunity. If you're a dentist, there's a lot of groups out there buying dentistry practices, and they're paying multiples upward 8, 9, and 10 times EBITDA. I think the same thing has happened in the optometry world, to where there's people out there trying to roll up that industry, and it's strategic, and they're getting much higher multiples and much higher values for their practices. And so, sometimes this travels in packs based on industries. And that's why at Exit Advisors, we try to tell people to keep the eye on the ball. Really, it may take 2 or 3 years to stage you, but you never know when that strategic opportunity, somebody's going to knock on your door. So,
Yeah, obviously there's a lot of synergies and value that can be added with someone in the same line of industry. But maybe Aaron, you could talk a little about some of the financial buyers, private equity, search funds, individuals.
Sure. And I mean, private equity is, when people say it, they mean a variety of different things. It's a broad term, basically used for investing in companies that aren't publicly listed. So while it typically refers to takeovers of companies, there are a number of different flavors of private equity structured in different ways. Some are industry specific. So, you know, Gary made the point that usually your strategic buyer is in your industry. The private equity investor or buyer may be industry adjacent, or they may have an industry expertise, and they tend to take a lot of people that are formerly out of industry. So they have an understanding of the industry. One of the key things for the financial buyers versus the strategic buyers who are looking to expand a market or bring in an add to their product offering for customers, financial buyers have a set of performance metrics that they develop prior to going out and prospecting for would-be targets. And they, as the term implies, financial buyers, they're interested in a return, and they have a return horizon, which can be a period of as little as 3 years or as many as 5, depending on how the company performs and whether you are part of an individual purchase or a group of purchases that they're making to resell. It impacts the, you know, strategic versus financial. It impacts the type of purchase price that may be offered as well. Private equity firms, depending on the target, can bring forward cash sometimes to completely cash out the seller. They're interested in the product. Strategic buyers might have an interest in performance that is different than the financial buyers. So they'll impact not only how the buyer approaches their due diligence, some of the elements that they look at. In the strategic side, they'll look beyond just the company itself, for instance, relative to their strategic goals. And it'll impact the type and quantity of consideration or payment that comes at closing. These are, of course, all generalizations, and every deal is different, but there's some general trends within these two categories that can allow a seller in particular to predict how a particular party might behave in a transaction.
Great, thank you. Mark, anything to add? Any other color around, you know, working with strategics or financial buyers, pros, cons?
Gary and Aaron did an excellent job, and he stole some of my thunder. I think strategic is a longer term view. Someone where, you know, if there's a good buyer and seller, that the buyer has maybe more equity at stake, a longer term horizon, likely as an employee or an officer of the company. There's a joining of visions, and there's a tremendous amount of value that can be created there. I look at the financial buyer as a buyer of cash flows, and they're doing what they need to do to get the return on their cash flows, likely to have a shorter time horizon that Aaron talked about, and then exiting to the next deal. Those two sort of define the either end of the spectrum, and I'm sure there are lots of iterations in between.
Yeah, and one last note, I think from a valuation perspective, you know, Gary had mentioned this, a lot of times the strategic can find these synergies and you know, overlaps and existing knowledge in the market where they would pay a higher multiple, but doesn't rule out, you know, private equity. I think Aaron mentioned, you know, if they have a niche or if they're doing a bolt-on acquisition, adding a lot of smaller companies within their portfolio to kind of merge into one larger entity, they can get multiple arbitrage, as we call it, and you know, wouldn't certainly rule them out of the equation. So from a valuation perspective, typically we'd probably see strategic having a higher value, but that's not always the case.
You know,
That-
something else to bring out, Andrew, I think that's something I'm not sure that we're going to talk about in the remainder of the discussion is the importance if you only have one individual buyer,
Yeah.
you know, the informal auction. And so you may only have one private equity looking at your company. You may have several strategics. So when you get into the informal auction, not one or the other knows what the other's offering, correct? And so you can get in kind of a trap if you have an individual trying to purchase your business, because really the power resides with them as opposed to you, the seller. So just something to point out.
Yeah, I mean, fit and having optionality is, you know, extremely important, which is something that we like to focus on as well in our process. So, you know, next in line, not necessarily going sequentially, but this falls in place next would be, you know, the LOI. And I want Aaron, you know, to kind of start us off with this next segment, and then, you know, follow up with Mark, but maybe walk us through some of the terms and processes of the LOI, things to look out for. You know, maybe explain the litmus test to us.
Sure. Well, you know, the LOI comes depending on the process of the buyer. And again, this is a difference between a strategic and a financial buyer. The LOI may come during different parts of the process, and they may simply come during that part of the process as a reflection of the internal process of the would-be buyer. In some cases, they come earlier. In some cases, they come later. For example, on the private equity side, you have this set of metrics, and the buyer will conduct some preliminary due diligence based on financial disclosure. And then based on their approach to purchases, will develop the letter of intent, which of course outlines the general and material deal terms. And then after the LOI, it's followed up by further due diligence, often delving down into the operational level. Whereas in my experience, strategic buyers do a lot more upfront due diligence on all levels before they get to the LOI stage. But the LOI is why I often refer to it as a litmus test for the deal. Is it is a sort of a rehearsal, if you will, of the main negotiation of the transaction, because you've had some initial discussions, the buyer has gotten a chance to kick the tires a little bit, and they start putting some terms into the purchase agreement, which include, you know, for sellers, hot button issues like how much I'm going to get paid, or what's the formula for how I'm going to get paid, and when I'm going to get paid it, and in what. And so sometimes you get sort of a perfunctory generic letter of intent that's non-binding, which is basically just the party's agreement to be exclusive for a period of time while they're talking to each other. But sometimes the buyer will want to come in and lock in certain key points, especially strategic buyers, when they've done a lot more due diligence up front. And how the parties respond is why I call it the litmus test to the rest of the transaction. So one of the things that Gary and I were talking about earlier today was one of the pitfalls of this process in going through an LOI is the benefit is that it helps focus the parties on these key terms and sort of ring fence the parameters for the future negotiations. But the danger is that you also get sucked into negotiating those details right away, often before due diligence is complete. So it's a bellwether for how the deal is going to go. And but it's also a great tool for vetting whether your counterparty, how they're going to respond during the deal.
And Mark, how about from you? You know, both you and Aaron have separate deals, but you've worked on deals with exit advisors and have had good and bad come out of the LOI process. So let me rephrase that. How binding, the LOI is not binding, but how much do you want to try to set the terms up front during the LOI, or is it better to keep it more loose for ongoing negotiations? And what kind of complications do both of those aspects bring?
Yeah, I would say it sort of just depends on the buyer and seller. My sensitivity around LOI is I may akin it to speed dating prior to getting married. You've had an opportunity to kick the tires, and then you have maybe a longer engagement thereafter, due diligence, and you finally decide, yes, you want to sign the deal and close it. A lot can happen in that process in the meantime, depending on the financial sophistication of the seller, the financial sophistication of the buyer. The seller in particular may be of a view that the deal is more firm than they think. And that can cause problems, right? There's can cause tension between the buyer and seller that shouldn't be there. I think it's important to note that this is, in my view, sort of like an option period where both can do some more digging, more understanding, particularly if there's going to be an ongoing employment arrangement. Are these people who you want to be your partner for the next 5 to 7 years? It gives you an opportunity to really think about what you want to do and under what terms you want to do them. Likewise for the buyer, I think the LOI allows you to have that exclusivity to explore and have time to sleep on it and wait a hot minute before you make a decision simply based on money. In many cases, there's other pressing issues. You don't want to take a paycheck and be miserable for 5 years. You earn every dollar of it. And so from my standpoint, I think it's an important part of the process and one that should be thorough and probably done early on and allow good due diligence to happen thereafter.
Yeah, and look, we just had a question come in. Could a seller execute multiple LOIs at the same time? And I was going to actually add to this. So typically, Gary had mentioned this earlier, if we're running more of an auction process where, you want to have as many, as a seller, you want to have as many buyer possibilities, options to judge valuation, fit, long-term strategy. And so to my knowledge, typically you don't execute multiple LOIs. Usually at that point, you've committed to a buyer. However, you could have backup LOIs, but as a kind of a precursor to the LOI, you can have an IOI, indications of interest, in which at that point you're kind of submitting, you're getting the buyer or the potential buyer to submit, maybe a looser terms, more broad valuation range, but showing, hey, we are interested, somewhere in the $20 to $30 million mark, assuming these things check out. And to answer your question, Stephen, IOIs, you would typically receive multiple of those, kind of whittle it down to best and final, and then move forward to having a formal LOI submitted. And you could have backup offers in case things fall through during due diligence or someone backs out.
Yeah, I think, Andrew, it's all a function of how hot the market is and the relative bargaining power of the seller versus the buyer, right? Because I can remember, and you guys probably can, during the internet boom, in the early 2000s, where tech targets would refuse to sign exclusive non-disclosures and letters of intent for negotiation periods. They want to keep all their options open because there were so many prospective buyers in the market that they had that kind of leverage. But buyers invest a ton of time and resources in this. So you will see in certain industries, you will see a propensity for buyers to not only want the exclusivity in the LOI, but they will push, contrary to what I heard earlier, they will often push for a lot of key selected provisions that are in fact binding should the transaction close. In other words, the parties are committing to a methodology on valuation or price or a certain method of payout on the purchase price.
Well, and it's really funny. There's kind of a correlation. We're in football season. I kind of look at the LOIs to pre-kickoff, right? Two teams are committed to play against each other, and then they got to get it on the field and do the deal. And the LOI, you do have to give an exclusive, typically a period of time to allow the purchaser to do their due diligence. But the LOI is just basically teeing up the transaction. It's not the purchase agreement. So, and I think a lot of people mistake that. They think the deal is done when the LOI is signed, but that's not the case.
Yeah, so Gary, I guess on that point, let's move to the next conversation about the purchase agreement. And there's obviously two major there's asset versus stock sale. Maybe you can give us a kind of a brief on the two and why one would be selected over the other.
Well, I mean, a stock sale is where somebody is purchasing the stock that you own in an entity. So under those circumstances, the entity will transfer to the new owner as is. So they will take that entity with the assets, the liabilities, and the equity section, and it will have a continuation. Okay, so your capital gains is going to be basically outside basis. It's going to be your basis in the stock that you hold to own that entity. There's some real advantages to that if you're in the right industry. You've held your company for over 5 years and you meet all the qualifications for a code section 1202E in the IRS code, to where you can take the smaller of $10 million exclusion on the gain or 10 times basis. So, I mean, if your basis is $10 million, I mean, figure it, you could get a huge exclusion. And so there are some real advantages to that type of transaction. However, most purchasers are going to want to buy your assets because of potential trailing liabilities. So they'll want to come in and buy your assets. And so that's considered an asset sale. And they'll pick and choose what assets they're purchasing. And then there will be an allocation of those assets and an assignment of price value. Well, from a tax standpoint, goodwill is still treated like capital gains. And most transactions that we see, there's not a lot of top-heavy tangible assets or hard assets. So most of that transaction is in fact goodwill and does still provide, a benefit to the seller from a capital gain standpoint. Now, one trap you really don't want to get into is you have a C corporation and they want to buy your assets. And so this can create a real tax issue because it's double taxation. So first of all, a C corporation does not have capital gains treatment inside. So you would pay ordinary tax rates for the asset purchase, and then you would have to get the cash out of the company, either through a form of a dividend or compensation. So your tax burden, even with today's tax rates, could be as high as 45, 50%. So when you're structuring your transaction, something I always say that it doesn't matter how much you sell it for, it's how much you keep. And, the American people are kind of brainwashed with the tax laws that it's really funny. I hear, well, I'm getting a refund of $800. Well, you paid $800,000 in taxes. I mean, so, it's the same thing that holds true in a transaction. When you go in and you start structuring this transaction, you've got to look at the asset versus the stock transaction. And Aaron can probably go into some detail on how that can be negotiable as well, or Mark, to where one or the other, you can still negotiate off price to absorb some of the tax effects. So.
Mark, I guess from an audit perspective or a due diligence perspective, I guess I should say, what are some of the key differences between what are going to be looked for by the buyer if they're undergoing an audit for a stock sale versus maybe an asset, and is the due diligence vary between the two in terms of severity?
There could be in situations, there is relatively new guidance embraced by both U.S. accounting standards as well as the SEC about the definition of a business. And it's a fairly technical definition about, the inputs and their other employees are generating revenues, other outputs, things along those lines. But when you acquire assets, you have some gating questions that allow you to maybe step out of a business. And you have a sort of simpler accounting. You may not have 305. You don't have an acquisition of a business. You may not have 305 financial statements that are required to be audited and placed on 8K, which is just another phase of an acquisition of a company or a business if the buyer happens to be public and the acquisition is significant. Those are a couple of things that come out from a GAAP standpoint. I think the key thing from the seller perspective is the taxation. And I think the other side, we're facing an environment where there's never enough of anybody else's money from at least government regimes. You have to be sensitive to, if you're a buyer, what is your tax basis? Right? There is some tax benefit given to the seller. The buyer is really not getting any tax benefit, I don't think. I think, in fact, they just probably get carryover basis. And the question there is, well, is that equitable? In other transactions, they may get a tax step up and thus have greater deductions in the future, assuming they're profitable. Just a couple of thoughts there. I mean, maybe Gary or Aaron has something to add.
Yeah, Aaron, from, Gary had mentioned, a big difference between stock and asset is, with stock, you're assuming all the company pretty much stands in existence and you assume the liability. So from a legal perspective, maybe you could dive into risk and what has to be vetted through, from the legal end.
Sure. And if you've listened to a webinar or read an article before on the difference between stock and asset sales, the speaker, the authors typically talk in general terms. An asset sale is good for the buyer because it's decreased liability. The stock sale is a higher risk. And generally speaking, that's true, but there's nuance there. Sometimes there's a great deal of advantage to buying the equity because the target company has permits or licenses or certain rights which are key to the value of the deal. And the only way to get those without having to apply for a new permit or a license or whatever, usually it's a government granted right, is to buy that equity. And on the asset side, it's not always, rosy either because of the concept of successor liability. So if you buy the assets of a company and come in and take up the same building that they occupied, you use the same business name, albeit in a different entity, you hire the same employees, you service the same customers, and you're sued for an act prior to the closing, if the issue of liability and indemnity is not addressed in the purchase agreement, the law considers you to effectively be the same person. And we saw that a lot, for instance, in environmental cleanup matters, especially in the 90s. That was a big issue. Whenever it's called a list of identity factors, and even in an asset deal, if you check all those boxes and you're so similar to the target company you're acquiring, whether you end up having indemnification rights or not under the agreement, you're probably going to be hit with some lawsuits from pre-closing liabilities, simply because of those identities, because it's difficult for would-be litigants to tell the difference between the two parties. Now, that all being said, there are a lot fewer equity, stock deals today than there used to be for that particular reason, because of the general liability associated with it. They do happen. The ones that I've seen have been by strategic buyers who are acquiring that company, maybe because of the permits and licenses, but also because of contracts. And the only ones I've seen in the last 5 years have actually been exit advisor clients who were so well prepared that when judged against the relative risk of buying the equity versus the assets, the buyer felt comfortable with the risk based on their due diligence of the target. So it's not unheard of, but it's not always as cut and dry as it may appear in terms of stock versus assets.
Thank you. Well said. Let's move on to our next topic, which is going to have a lot of meat to it. Forms of consideration, which is essentially, how is the seller getting paid? And maybe we can start with you, Mark, on, is there, in your opinion, do you think that there's an ideal transaction structure for getting paid? Is all cash up front better? What are some of the ways that we can structure this, and why would we do that?
Yeah, I was looking at this slide. I was thinking to myself, maybe I would change the title to "Juggling Dynamite: All the Benefits, Zero Explosions," because this is literally where things get really hairy. And what I would say is, I think most people here listening can probably figure out what these bullet points mean. I can touch upon a few of them if they'd like, or others can. I will tell you the most important part of going through A, B, and C is making sure that the seller understands the risks and value associated with each of these elements. What is the risk and value of an earnout? What is the risk and value of taking stock with a holding period? What is the risk and value of a note, et cetera, because that then weighs and it educates the buyer to say, what is the right mix? I'm sorry, for the seller. And it maybe this is a baseline question, or if there's a seller who is exiting a business and retiring, the question I would have for them, and it's an honest question, and it's a personal question: how much cash do you need to be comfortable? And you don't have to tell me, but you need to think about that number, because that influences the way a negotiation is handled, how much cash you want to have, what kind of employment thereafter, if any, that you want to have. And I think that's an important thing. Likewise, important to the seller is to understand the buyer's predicament. Unless there's an individual buyer who has no investment committee or no board to answer to, and just has lots and lots of money, I find that to be few and far between, actually. Most people answer to somebody. And so, a buyer, even a very sophisticated buyer, is going to have sophisticated individuals that they have to answer to. And understanding that delicate balance in those constituencies that one has to maneuver to get a deal done, I think is a very important piece of information for the buyer. It allows them to work together to come to what I'd like for everybody to have in a situation of a good negotiation is a win-win proposition. Because particularly if there's an employment agreement coming thereafter, you want to be good partners with each other, and you don't want to have a bunch of ill will carrying over after a negotiation. There were some questions, I think, around what's the value of an earnout and why would someone do that? I will tell you from my shoes, if this is a strategic buyer, for example, who's trying to finance working capital in future years, the question is, how do they finance it? Do they finance it with equity? Do they finance it with debt? Or does the acquiree throw off sufficient cash to finance its own working capital? And if so, would they be willing to defer some incremental value if the seller would be willing to finance their own working capital in subsequent years? That would be a perfect example of why there might be an earnout there. It might be also an incentive to keep the employee base there. It might be an incentive to keep management engaged, working as they always have as well. But I'll pause there for fear of taking up too much time, Andrew.
Yeah, Gary, maybe, one thing I was trying to figure out how to dive deeper into the earnout. And I think one thing that you would be able to touch on with your understanding kind of the income statement from top to bottom are some of the earnout metrics that buyers set. And, for the seller or for the deal team to help control how the earnout is going to look for the seller, what are some things to consider? I guess what would the perfect earnout, if you're going to have an earnout, how would you want to structure it in favor of the seller so that they cannot have control and can meet these provisions?
Well, I mean, obviously for the seller, the best matrix would be revenues, right?
Yeah.
That would be the most simplistic thing. There's nothing can be corrupted. As you go down the income statement, cost of sales, the new purchaser could overexpend. They may find new suppliers. The price for the product may increase. They may add additional labor. They may not be able to manage the process as well as you manage the process. And all of a sudden, the gross profit margin goes from 50% to 32%. Also, with fixed costs, when you get down to income for the earnout, there's a lot of expenses that can go in there from a standpoint of direct costs. There can also be overhead allocations. And so what you need to do is work closely with legal counsel, especially on how the earnout is laid out. Okay, what is used for the earnout? Once again, obviously revenues is the best. A lot of times the purchaser is not going to want to use revenues because they're purchasing an operation, they're purchasing a going concern. So they're going to want your feet to be held to the fire, that the operating cost and the cost of sales are going to stay intact as well. And so, in the purchase agreement, it's got to be very well laid out. There's going to have to be good boundaries built and a good understanding of, okay, each possibly typically 2 or 3 years of earnout will come into play. Normally there's a hurdle. And so if you hit your particular numbers, then you're going to get a piece of that consideration. So, maybe 50% of the deal is cash, 30% of the deal is securities, 20% is earnout. So the only way you're going to get 100% of your consideration is to hit those hurdles. And, and there could be some upside. We're working with the deal right now that there could be some upside on the earnout. So to where if numbers exceed expectation, maybe the purchaser can get a little bit more out of it, either in the form of an employment agreement or in the form of additional consideration.
Yeah, it doesn't have to just be a limit to your consideration, but it can go both ways, which is important. Aaron, maybe you can kind of chime on, Gary just talked about the metrics, but maybe less from the financial perspective and more of how it's solidified legally, or any other comments that you have to consideration.
Valuation, or I should say earnout and all kinds of contingent consideration calculations in the agreement for post-closing consideration are always, if not the most, one of the most contentious areas in negotiating the whole agreement. And the challenge for the attorney is to take what is in essence an equation and express all the relevant factors in the document, because ultimately these are provisions that are just ripe for lawsuits. And they're one of the areas where attorneys have to take care and time to be as explicit as possible and as redundant as possible in explaining how this formulation works, because a loosely drafted earnout calculation provision is in my experience, it's almost certainly going, depending on how much of the purchase price you allocate, of course, it's almost certainly going to be contested. And it's often one of the things that's left to later in the transaction after the buyer has gotten through more and more of the due diligence, has more and more time to talk to the business team, and maybe even start talking to prospective customers, and different red flags might start popping up for them. And the contention between the risk that the buyer's facing and that the seller wants to avoid all go into that formula as you push to the closing. So and Gary and I had recent experience where we were, the seller was not in a very advantaged position, and the buyer was using a very loose earnout formula, or if you will, if you could even call it a formula, which allowed for a great deal of subjectivity in how numbers were determined during the post-closing period, which places a tremendous amount of risk on the seller. But it's something that's worth spending the time on, because that investment in being clear and precise, and sometimes even referencing tables and examples, are very valuable, because the cost of the litigation over those provisions is extremely high because of the need to use experts, especially in litigation over earnout provisions.
Yeah, before we move on, Aaron, you really hit the nail on the head. And I actually see Mark Saffers is on here, and he and I worked on a deal together. And to your exact point, Aaron, the openness to interpretation, for example, we were working on an earnout that was based on revenue and gross margin, the combination of the two. And it's, as simple as saying, hey, the revenue has to hit or exceed this number, and gross margins have to stay at or above this percentage. And all of a sudden, it's not that simple. We had to get down to such excruciating detail as to like, what system are they using to track, billable hours for contractors, and what system and what rates are they going to use, and defining that, because all of a sudden they could say, well, hey, we switched them over to this, and we changed the interpreter pay or the contractor pay to a different amount. And all of a sudden, like Gary was alluding to, you can start messing and manipulating with it. It has to be really, really, really well spelled out.
And there's this human impetus in, you've been on those conference calls, right, where people are discussing that formula. And people use these terms like the gross margin in the conversation, and it's like being from England or being from the United States. You're technically speaking English, but what you mean by those words can be very different, especially when you have a financial buyer who may not necessarily understand the life cycle of the business and the methodologies that are used with customers and revenue. So it's dangerous to be too vague, and it's helpful to walk through concrete examples during those conference calls and meetings.
Yeah. Well, look, we have some other points in here, but I want to make sure we save time for the last topic and for Q&A, of course. But it goes without saying, if anyone wants to elaborate on this further, please reach out to us, because we will. We'd love to talk to you about it. So to wrap things up, before we go to Q&A, I want to talk about post-sale considerations. And, one of the biggest aspects of post-sale considerations is the asset allocation. Mari, you can go to the next slide. And Gary, maybe you can kick this off. Maybe from a tax perspective, what are some tax strategies around asset allocation that can benefit the seller, hurt the seller, or even benefit the buyer, or benefit both parties?
Well, and this is something, it's really interesting. This is a process that's typically kind of the tail end of the train, that it seems like everybody wants to avoid. I don't know why, because you've got to both file a form with the Internal Revenue Service with the explicit asset allocation. And so, this can become part of a negotiation as well. So consider this, let's say it's an asset purchase. Okay, so obviously the purchaser is going to want as much of the asset allocation attributable to tangible assets, right? Because they can depreciate those tangible assets over 5 and 7 years typically, and maybe even get bonus depreciation. So they can be kind of a tax windfall to this. Well, what happens to the seller though? With our current tax laws, typically those tangible assets are fully depreciated. So what the seller would have to do is pick up that gain as ordinary income because that's depreciation recapture. And so obviously the seller is going to pay higher taxes and the buyer is going to get tax advantages. So that asset allocation process really should be an ongoing process in this transaction, negotiating the deal, because it has an effect on, you know, what the seller is going to keep and then what the buyer can deduct. A lot of transactions, it's kind of a no-brainer. I mean, if it's an asset, you know, purchase, a lot of it is goodwill. A lot of it's client list, customer list, all the intangibles associated with the business. And that's well and fine because that's 15-year property, okay, for the purchaser. So they amortize it for tax purposes over 15 years. If they're following GAAP, then it's not amortized. The only time that you would write that intangible down if something happened that would create, you know, a loss in value. Okay. And then so for the seller, if it's all intangible 15-year property, goodwill, then it's capital gains. And so as you can see, I mean, you've got to get on the same page. And this is something that definitely needs to go in the purchase agreement that I'm sure Aaron can comment on. And, you know, we have had problems at the tail end of transactions to where this wasn't focused on. And all of a sudden, everybody wants to file their tax returns and everybody's looking at each other going, hey, what was the asset allocation?
Yep.
So it's pretty interesting.
Yeah, Gary, yeah, this is one of the reasons why you don't let the corporate lawyers completely drive the transaction, because they will leave asset allocation to the very end, because a lot of them aren't familiar with the tax ramifications, and they'll push it off because they're focused on other things like indemnities and maybe the earnout. You've got to keep the tax guy, your tax advisor, plugged in along the way, because you get to the end and everyone starts arguing over the allocation. Then you've got to squeeze the balloon because somebody who gets the allocation in their favor over here, they start wanting to renegotiate previous parts of the deal. And it can cause a deal to stall and implode, you know, during the last inning of the game.
Yeah, well, I think that pretty much wraps up the presentation, unless anyone has, you know, Mark or Gary, you have final comments on asset allocation. Otherwise, we can break into Q&A. So a couple things that were submitted beforehand. I'm going to go through those and then tackle the stuff that was submitted during the presentation. But this is to the panel. Anyone chime in if you want to kick it off. But what is the most commonly left out or underutilized resource that can add value or grease the wheels of a transaction? So what's a resource that often gets overlooked or left out that would, you know, help facilitate or increase the valuation? I can kick that off just since it's top of mind for me. You know, we talk so much about the earnout, and one of the biggest issues you have is seller and buyer valuation expectations. And, you know, an earnout or rollover equity is a great way to bridge valuation gaps. I think a lot of people think cash up front is always the best option. In some cases it is, but some cases it's not. It leaves no upside. So my only quick point here, you know, we talked about the earnout quite a bit, but Gary made a very important point. You don't have to be constrained to the earnout. You can make the earnout double-edged to where there's upside if you exceed certain metrics. And don't ever underestimate the value of rolling over 10, 20, maybe even 30% equity into something that you know better than you know the market. You know, what if you have a tens of millions of dollar exit, you don't necessarily want to put all that into the stock market necessarily. You want to diversify, and what better way to diversify with another strategic group that understands your business and that you understand as well, because that second bite of the apple could be worth a lot more. So, there's tools to bridge valuation gaps. Anyways, I'll hand it over to somebody else.
Yeah, the second bite of the apple can be very lucrative. Let's say that a publicly traded company is purchasing you, and maybe you're one of the first targets, and let's say the stock is at $1 a share, and you come in and your operation makes a difference, in the profitability of that company, and all of a sudden it's $5 a share, and part of your consideration is 100,000 shares. That second bite is really, really pretty good. Also, you could have get purchased by a larger company that in turn 2 or 3 years later get purchased by a publicly traded company. So there's ways that consideration, not just all cash, but maybe receiving stock and earnouts, you can have a little bit more upside, I do believe, as a seller.
So Andrew, my thought on the question, were like greasing the skids, greasing the wheels of trying to get a deal done. If you look at a buyer and you look at a seller, they're going to have likely different sophistication levels, different skill sets. And so what skill or person might be most needed or maybe underappreciated but needed at the time of a deal or negotiation? I would say it's the skill that's not obvious on either the buyer or seller side. You come across individuals that are very technical with respect to a particular type of technology or invention or process, but they know nothing about deal negotiation or nothing about the stock market or nothing about financial statements and nothing about negotiating a deal, or really have very little business acumen. And so that individual needs to be uplifted in a number of different ways. And if you contrast that person's skill with a seller who may have a great deal of sophistication, you can see how it's tilted in one way where it's not necessarily, it can certainly run off the tracks pretty quickly simply because the two aren't synced up together relative to their relative sophistication.
Andrew, I would just add to that. I don't know that it would lubricate or grease the process towards closing, but having done a lot of buy-side work, I would say a bad deal avoided is a positive outcome. And I think one of the underestimated tools that are used are other forms of business intelligence. But, you've got a buy-side team that is, basically a bunch of very competent people, highly educated people who have their nose in a laptop and a bunch of spreadsheets. And we forget sometimes that these businesses are made up of people, and people are messy. And so using investigative services, running lien and litigation searches, not only on the business, but on the principals, can identify risk areas that you might not have thought of before. It pays to peel back the layer from just the entity you're looking at and the four corners of that corporate entity or whatever it is, and look at the primary owners, especially at a prospective target.
Yeah, you mentioned business intelligence as far as the transaction, but that is applicable way before too. So much of what we try to do is help clean up these businesses and de-risk them, as I mentioned in our intro, to add value. And if you have data and measurable data for every aspect of your operations, and whether that's in the form of business intelligence, the idea I'm trying to get to here, it's streamlining your operations and making sure everything's clean, and you can point your finger at something and you can track it, because that makes not only going through due diligence easier, but that really takes a lot of the risk out of it for the buyer, because they see it, they understand it, they can, it's tangible right in front of them. It's not a hypothetical. So keeping your business clean and ready to sell as if you were going to sell it tomorrow, even if it's years from now, is really important. Another quick question we have was, going back to the types of buyers, and specifically focus around the individual operator or search fund, how deal size and owner involvement plays into that type of buyer. Per his words, there seems to be an opinion that an operating owner is less attractive than a strategic. And is that the case? From my perspective, no, not always. Typically an owner operator or a search fund might be looking at smaller size deals. Yes, but in what scheme? 10, 20 million, is that small to you? Maybe it's small by lower middle market definitions, but there are benefits to that because, even David Acosta asked this question, how do you protect your employees? Well, an owner operator or a search fund, they're not going to want to, acquire your company and then fire everybody. So you're really going to protect your headcount, protect your employees, do right by them. And a lot of these owner operators know the industry just like a strategic does, but they're going to kind of let the legacy of the business keep on. I don't know if you guys have any other thoughts, but benefits around the owner operator or search fund. If not, yeah, we'll move on. Let's see, the last one, and I just kind of referenced this, but it was from David Acosta, and Mark had already answered this offline, but I wanted everybody to hear it. What type of buyer is better for the seller if he or she wants to protect the employees as much as possible? And I just kind of touched on the first part of that.
I will give my thoughts on it quickly. It depends on the nature of the business, right? If it's human capital intense, if the nature of the workforce is specialized and unique versus something that's easier to replace. In some cases, just the nature of the workforce and their technical abilities may be enough to protect them. In the absence of that, I think you're going to have to go to agreements, lock up employment agreements in such a way to, because if a buyer may look at that and say, I don't need those people. I have my own people, or I can get different people or cheaper people. Ultimately, that will come at some cost, likely in consideration, is my view. But it seems to me that ultimately it comes down to how valuable those employees are. And if they're not particularly valuable relative to the ability to be replaced or have replacements, that makes it a little more challenging.
Thank you. Well, I think we're just out of time, so I'm going to go ahead and wrap it up. But if there's other questions or anything that we missed, please, as I said earlier, feel free to reach out to us. The Exit Advisors team, Aaron, Mark, Cooper CPA Group, we're all here. We're here to answer questions and standing by. So we really appreciate everyone joining us today. And thank you to Mark, Aaron, and Gary for the panel series.
Thanks for having me.
Have a good one.